Hello friends, welcome to the channel JIV and CIV Made Simple. So this is our unit number 30 theory portion and of BFM, and the topic name, as you can see, is interest rate risk management. So before diving into the chapter, let's see what are the important topics which we are going to study. Objective, introduction, essential of interest rate risk, sources of interest rate risk, effect of interest rate risk, how to measure it, and there are some techniques which we will discuss. What are the measurement techniques, how to control interest rate risk, control and supervision of interest rate risk management, and 30.9 you can see sound interest rate risk management practice, and what are the RBI guideline on interest rate risk rise in banking book. So basically these are the 10 topics which we are going to study. We will cover them in 2 to 3 videos. So let's start with the first topic we have is the introduction, right? So friends, did you know that there was a time when banker has such a simple life that they follow the 363 rule? You know about this 363 rule? Let me talk about it. So banker used to follow something called 363 rule. It means that take deposit at 3%, lend at 6%, and head home by 3 p.m. Right? So first 3 means you take deposit at 3%. Right? The second 6 means lend at 3% and go home by 3 p.m. So this was the rule under once upon a time, right? Sounds like a dream job, right? Well, things changed drastically after the 1970, and that is exactly what we will break down today. So it was just like a dream job. You don't want that you should go home by 3 p.m. Obviously but you can't do, right? Because the things have changed since 1970. So we will discuss in detail why it changed. So you know what happened before 1970? Banking was heavily controlled by government. Right, banking was heavily under government control, right? So bank had to follow fixed interest rate both on deposit and loan. So there was a concept of fixed interest rate which bank have to follow both on deposit as well as the loan. You can clearly see written here that deposit were accepted at the mandated rate, right? So this means that they did not have to worry much about markets ups and downs, right? So they were insulating, clearly written, insulating interest rate from market fluctuation. So market is moving up or market is moving down, it does not matter, right? So pretty limited, right? So their main focus was to just maintaining credit and liquidity, right? So what was the main primary focus? Primary focus on credit and liquidity risk, these two things, not market risk. And ensuring they gave loan wisely and have enough cash to meet this withdrawal. So when I say liquidity, it means they should have enough cash to meet the withdrawal, and when I say credit, it just means that wisely they are giving the loan, looking at all the parameters. So that these two things they have to take care of, not the market risk. But then came the 1970, right, and the things started shaking up. Government decided to deregulate banks. So here is the key concept which happened in 1970, that is deregulation of the banking system. So government decided to deregulate bank, right, meaning bank could now decide their own deposit and lending rate. Sounds like freedom, right? Well, not really, because this exposed bank to a new monster which is what we call interest rate risk. So once this deregulation happened, bank is exposed to a new kind of risk which we call as interest rate risk, and we will discuss in detail how, right? So many banks were simply not ready for this change. You know what happened? That many banks were not ready for this change, right? They were borrowing short-term money. So what banks were doing? These are the suppose bank. So they were borrowing something called short-term money. When I say short-term money, what it means? It means that which has fluctuating interest rate, but lending for the long term at fixed rate. But they lend for the long term, right? So they borrowed money at short term and they lend at the long term. So when I say short term money, which means has fluctuating interest rate, and lending for the long term at fixed rate. So short term, it means lending rate is fluctuating, and long term means lending rate is fixed. So when interest rate skyrocketed, their borrowing cost is sort of what will happen. Suppose interest their lend what was the practice? What I'm telling you, that many banks were borrowing short term money, right, which has fluctuating interest rate, and lending for the long term at fixed rate. So what will happen? Can you tell me what will happen when the interest rate skyrocket? Means interest rate increases very high. So what will happen? That their borrowing cost will increase, obviously, because they are borrowing short term money at fluctuating interest rate. Since interest rate increase, so borrowing cost will obviously increase, right? But their loan earning remain low because it was at fixed interest rate. It was not changed. It was not affected by interest rating skyrocketing. So what was the result? The result was huge loss. You simply see you are borrowing at high cost and you are lending at low price. Obviously your losses will increase or profit will decrease. So loss will increase. That is what happened. So this poor risk management led to multiple bank failure in 1970. You know, because of this poorly managed interest rate, multiple bank failed when in 1970. Let me show you. It is written clearly. Here it is, right? So in the 1970 to 1990, many bank failure, which was because of the poor interest risk management, right? So understanding how bank manage risk is crucial for any banker, and obviously as you are preparing for CIIB, so the concept of interest rate risk management will be a game changer. To the next part, we will explore how bank tackled this problem and the key strategy they use today. I hope the problem is clear now, right? So what are the problem faced? Now, imagine a time when banking was super predictable, no surprise, no major risk, bank had fixed interest rate, steady profit, almost no stress about markets ups and down. Sounds like a safe job, right? But then came deregulation in 1970 and boom, everything changed. Banks suddenly had to navigate a risky world of fluctuating interest rate, and those who could not manage, well, they did not survive. Let's break it down in simple terms. So we are talking about pre-1970. So let's start with the pre-1970. Let me revise you what we have covered in the previous slide. So you know, pre-1970, what happened? Just wait a minute. Yeah. So friends, before the 1970, banking was heavily controlled by regulation. So it was regulatory restriction, right? Heavily controlled by regulation. Bank did not have to worry about interest rate change because everything was fixed by the government, right? Government fixed it was. Deposit rate, loan rate, everything. This keep banking stable and risk free. So what was the result? Pre 1970 bank was stable and bank was risk free. They have to only take care of credit and liquidity risk. Now then came 1970 and the government decided to let the bank set their own interest rate based on the market condition. While this give bank more freedom, it also introduced a new problem which we call as interest rate risk. Bank were used to stability and suddenly they had to deal with unpredictable interest rate change. Many simply were not prepared for it. What happened next? Many bank collapsed, right? They were borrowing short-term fund at fluctuating interest rate but lending long-term at fixed rate. So when interest rate shot up, their borrowing cost increased but their loan earning remained the same, leading to huge losses. So this mismanagement caused multiple bank failure from 1970 to 1990. I hope it is clear. Now bank have learned their lesson. One of their biggest strategy today is to protect their profit from sudden interest rate change. So this is the biggest learning, insulating interest spread against rate change. This is the biggest learning from these incidents, right? We know we have to learn from incidents which happen in our life. That is our experience, right? So bank also gain experience from it. So they do this by balancing the interest rate on what they borrow and what they lend. So what they do, this is something called balancing the interest rate. Balancing interest rate on what they borrow, that is liability, and what they lend. So they balance interest rate on liability and asset, right? This way they are not caught off guard by market fluctuation, right? So that is what is relevant here. They are balancing the interest rate on their liability and their asset. This way they are not caught off guard by market fluctuation. I hope it is clear. Now here is where it get interesting for us. In India, banking has also gone through deregulation. You know it very well, right? Banking has gone through deregulation. Indian bank now have the freedom to decide their interest rate based on the market trend, but with that freedom come the interest rate risk. So that this means that interest rate risk management, right? Interest rate risk management is the major priority for Indian bank today, right? I hope this make your concept clear. Now let's talk about the impact of interest rate change on asset and liability valuation. So basically here we are. Yeah, so before that, let me tell you about this essential of interest rate risk. You know, interest rate risk represent the potential threat to a bank financial stability due to adverse change in interest rate. So obviously this is inherent to the banking sector and a notable source of profitability and shareholder value, right? So this is the important point. Let's talk about some key points here, right? So interest rate risk fluctuation directly influence NII and other interest sensitive income and interest on operating expense. And the value of bank assets, liability, or balance sheet exposure instrument is determined by the present value of the future cash flow, which shift with the interest rate change. So suppose you want to find the value of asset, What is the value of bank liability? What is the value of off-balance sheet instrument? How do you find it? So you find the present value of the future cash flow. Obviously, these assets will generate future cash flow. So what we do? We discount it, right? We convert the future value to present value. That is called discounting. So by the method of discounting, we convert this future value to present value, and in the process of discounting, we divide by something called 1 by r to the power n. And what is this r? This r is something called interest rate. So you can easily see that while in the process of discounting the future value to the present value, there is something called interest rate which plays a super important role. I hope it is clear. That is why it is said that the value of asset, liability, or balance sheet instrument is determine the present value of the future cash flow. And obviously, if interest rate will change, this present value will also change. So you can see this interest rate has a significant impact on the present value of this asset, liability, or balance sheet exposure. I hope you are familiar with this present value. You have learned in JIB also, and also in CIB you are learning currently. So you know very well that the present value of asset, liability, or balance sheet exposure is significantly impacted by the change in interest rate. So this managing this interest rate risk is crucial for maintaining a stable financial condition. So you cannot deny the fact, you cannot undermine the impact of this interest rate risk on our for our strong financial condition. Now let's talk about this valuation, exactly how the interest rate change affect asset and liability. Let's talk in detail. So friends, ever wondered how a simple change in interest rate can make or break a bank? Have you ever wondered? Imagine you own a shop. Suppose you have a shop, shop, this which we call dukan. Suppose you have a shop, right? And suddenly the cost of buying goods goes up, but you can't increase your selling price. What happened? Obviously, suppose the cost of buying goods, you are buying goods and you are selling, that is what you are doing, right? So suppose the cost of buying goods increases and you are not increasing the selling price, what will happen? Ultimately, you have loss only. Well, bank face a similar problem when interest rate fluctuate. Let's break this down the simplest way possible. So the first question I will ask, that how interest rate change affect bank. So let me answer this first question. I think here it is written. Let me write down how interest rate change affect bank. Exactly how it affect bank. Let's discuss it. Bank work with asset. What are the asset for the bank? Can you tell me? The asset for the bank is a loan that it gives, right? Bank work with the asset, and also bank work with the liability. What are the liability for the bank? Like the deposits are the liability, right? So when interest rate rise, the value of both these assets and liability drop, right? To understand, when interest rate will rise, what will happen? Asset value will also decrease and liability value will also decrease. How can I say so? Because present value is equal to future value divided by 1 plus r whole to the power n. You can see easily that this value PV is inversely proportional to R. So if R increase, PV will decrease. That is why the value of assets and liability will decrease when interest rate increase. This is mathematically, I have proved it here. PV is inversely proportional to R. R means interest rate. When interest rate increases, PV decreases. Because already I have told you that the value of asset and liability is based on the present value of the future cash flow. These assets will generate future cash flow. So we calculated present value, and while calculation is done, it is divided by something called interest rate. So clearly interest rate is inversely proportional to the present value. When interest rate will increase, present value will decrease. I hope it is clear. So I say that whenever interest rate increases, the value of both these assets, both these liability drop. Just like the price of an old bond fall when new bond with higher interest rate become available, and when interest rate fall, the value of this instrument will increase. What will happen? Tell me. Suppose interest rate decreases, what will happen? Value of these bonds, value of these assets and liability will increase because they are inversely proportional. You know the meaning of inversely proportional? I hope you know. Inversely proportional simply means they are one is increasing, other is decreasing. If interest rate is increasing, value of assets and liability is decreasing. If interest rate is decreasing, value of assets and liability is increasing. I hope this make your concept clear. Clearly written. Falling interest rate enhance the market value of this financial instrument. That is what I am telling you. Right now. Simple, right? It is quite simple. So now you understand that how interest rate change affect bank, how interest rate change affect these assets and liability. Now my next question is the maturity mismatch problem. This is a significant problem. Let's talk about it. Here is where the real risk comes in. Till now it is manageable, right? Till now it is manageable. Now the real risk come in from here. Bank usually lend money for long term, like for home loan. Bank lend money for long term, for 20 years, 30 years, right? But borrow money in short terms. They borrow at short terms and they lend at the long term. So like suppose 1 year fixed deposit. So this mismatch can be dangerous. If interest rate rise, the value of long term loan fall more than the short term deposit. One thing is clear, try to understand. We have short term deposit, we have long term loan. These long term loan are asset, these short term deposits are liability, and obviously suppose interest rate is increasing, you know it very well that the value of both assets and liability will decrease when interest rate increase. Why? I told you earlier, because they are inversely proportional. I have provided you the logic also behind this scenario, right? So logic is clear. Now one thing is clear, that yes, I am increasing interest rate, okay, and this upper sign, let me show you by little bit. Okay, one thing try to understand here, that what I am doing, that I am increasing the interest rate, I am increasing the interest rate. Okay, now you know it very well that short term deposit will also decrease, the value of deposit will also decrease, and asset will also decrease, because they are inversely proportional. Now what happen is that the value of long term loan fall more. So you can see this fall more as compared to the decrease in the short term deposit. This means bank face economic loss, isn't it? What is happening? Let me give you example to make it more clear. Suppose the asset is currently valued at 50 crore, okay, and deposit is currently valued at same, suppose 50 crore. Suppose it is, the value of assets and liability are same. Now what happened? Interest rate increased by suppose 3%. Okay, not that much, suppose it is 3%. Now what will happen? The value of asset will decrease. You find the present value, you get the 50 crore, but now after the interest rate is increased, the current value will be suppose 30 crore. So how much drop it is? You can see 20 crore drop is here, but in this case you will see only it dropped to 40 crore, which means only 10 crore drop. So now you can easily see that the drop in the value of asset is larger than the drop in the value of liability. A drop in the value of asset is 20 crore, while drop in the value of liability is 10 crore. So you can easily see now that this, because of this interest rate change, the market value of asset decreases greater as compared to the market value of liability, and this will ultimately cause our economic loss. Obviously it is loss, right? Because asset value is decreasing at a larger pace as compared to the decrease in the value of liability, right? So that means bank face economic loss, and if not managed well, it could lead to insolvency. So now I think the question is answered, that how this mismatching maturity, and what is the reason behind it? The reason is that maturity mismatching, because you know the deposit for short term and loan is for long term. This is called maturity. Since the maturity mismatch is there, because of what is happening is that asset is decreasing at a faster pace as compared to liability. So you can see this plays a super important role, right? Now what is the real trouble? The real risk is impact on bank profit. Let's talk about it now, right? So you know the real trouble is the impact on bank profit. Here it is. So you know that the real trouble comes, just wait a minute, the real trouble comes from how interest rate change affect NII and NIM. You know about this, I think we have talked about it earlier, but in this topic we will talk about detail. So the real trouble comes how interest rate change affect the NII and NIM. Think of NII. What is NII? You know, this NII is the difference between interest a bank earn on loan. Let me write it down. Interest bank earn on loan. You know, when bank give loan, it earn interest minus what it pays on deposit. That means interest bank pays on deposit. Obviously when you deposit money like in the form of FD, bank pay you interest. So the interest bank earn on loan minus interest bank pay on deposit, this difference will give you NII, which is net interest income. Is it clear? Now think of NII as the difference between the interest of bank earn on loan and what if it pays on deposit. When rate fluctuate unexpectedly, this gap shrink. So let me give you example. Suppose current gap is 30 crore. Suppose current gap is 30 crore, and now interest rate fluctuate, interest rate increase by suppose 3%. Unexpected, it was an unexpected increase. What happened? It shrinked, it comes down to only 10 crore, right? So hitting the bank profit hard, because this is the bank income, right? Earlier the bank income was 30 crore, now interest rate increased by 3%, because of which this NII reduced to 10 crore. So this gap has shrinked, isn't it? And it ultimately affect the profit. So this NII is used to quantify the profit or quantify the earning of the bank. So how do we quantify it? We can use a technique, we can use a parameter which we call it NII, or net interest income. Now managing interest rate risk. So what is the solution? So bank use risk management strategy, right? I hope the problem is clear. What is the problem, right? The solution is risk management strategy, right? So bank use risk management strategy to balance the timing of their assets and liability. They track rollover rate. So here let me highlight this point, super important. So what bank track? Bank track something called rollover rate, right? Which means keeping an eye on when their deposit and loan will be needed to reprice. So when I say rollover rate, it means they monitor repricing when they need to reprice their assets and liability. Reprice their assets and liability. Right. A well-managed bank ensures that interest rate change don't wipe out its profit and or put its survival at risk. Obviously, if you are preparing for BFM, obviously you are preparing. This is a must-know concept. You are so concerned about interest rate. Imagine you lend money to your friend, right? At fixed 10% interest. But what if you borrowed that money from someone else for only 1 year at 9%? So you lend your friend for 2 years. Suppose you lend money to your friend for 2 years at 10% interest rate, and you borrowed from someone at 9% interest rate for 1 year. Right. So for the first year you make a small profit, but after 1 year, if suppose borrowing rate jump to 11%, suppose after 1 year the borrowing rate jump to 11%, you now have to pay more interest than you earn, causing a loss. This is exactly what happened to the bank, and it is what we call as this gap or mismatch risk, right? So that is what we are going, so why is interest rate risk so important for bank? That is our question. We are trying to answer this question. Bank make money by lending at higher interest rate, you know it very well. Then bank make money by lending at higher interest rate, right, than what they pay on deposit. But suppose if interest rate fluctuate, if this interest rate fluctuate, right, what will happen? Their earning can be at risk, you know it very well. So two things can happen, right? So let me talk about both the two things. So two things can happen. The first thing can happen is that interest rate rise. If the interest rate rise, the bank may have to pay more on deposit while still earning lower rate on loan. And second thing is that can happen is interest rate decrease. It means they might earn less on new loan, reducing profitability. That is why bank constantly measure and manage interest rate risk, right? That is why it is called maintaining prudent and acceptable of interest rate risk. So bank constantly measure and manage this interest rate risk, right, to stay profitable and safe. Now question is, what is this gap or mismatch risk? Let's talk about it. So gap risk occur when the timing of interest rate change affect asset and liability differently. So here you can see when the timing of the interest rate change, this timing affect the assets and liability differently. So let me give you some example to make it more clear that how timing of interest rate change affect asset and liability differently. So first example you can see that a bank borrow 100 crore at 9%. So this is the bank, it borrow 100 crore at 9% interest for 1 year, okay, and to fund a loan of 100 crore. So 100 crore loan it has to fund at 10% interest rate at for 2 years, okay. Now in the first year profit is 1%. Clearly in the first year the profit is 1%, okay. But after 1 year, if interest rate rise to 11%, so you can see after 1 year what happened, the interest rate rise to 11%. The loan was given to fixed rate, right? So after 1 year what will happen, after 1 year the interest rate rise to 11%. So the bank will lose how much? So instead of this 9%, it will become 11%. So it means what, bank is earning 10% only, while it has to pay 11%. Bank has to pay 11%. So ultimately it is minus 1% gain, that is 1% loss is there. So this uncertainty is what make gap risk dangerous. You see, this is the uncertainty because bank did not expected earlier that interest rate will rise to 11%, right? Till it was 9%, bank was at profit of 1%. But since interest rate rise to 11% after 1 year, because after 1 year this loan will match, this deposit will mature, right? So bank have to look for some additional deposit. Bank have to manage some additional deposit from somewhere, which they have to borrow at 11%, and this will cause bank profit to decrease. That is why this gap risk is so dangerous. So bank don't just deal with loan and deposit, they handle billions of financial transactions. If they don't manage their gap risk properly, they might lose money when interest rate change, right? Or their profit will become unstable, or their financial stability will weaken. So this is the first scenario which I have just talked now. Now let me provide you one more scenario to make it more clear. So let's look at example number 2. You can see in your book there is second example also given, that is managing interest rate risk. So friends, let's talk about it. Interest rate risk sound complicated, but what if I told you it is just like handling your monthly budget? Imagine taking a loan at a fixed rate, but your salary fluctuate, sometime high, sometime low. That is the kind of challenge bank face. So let's simplify this with three real world scenario. Right. So the first case you have is no mismatch. So let me talk about in the example 2. We will take three scenario. The first scenario is no mismatch. Means what? Think of it like saving money in FD for 3 months. So what you are doing? You are saving money in fixed deposit. Right. You are saving money in FD for how many months? For 3 months. Okay. So and investing in something that mature at the same time, like a government T-bill. So you are basically you are saving money in FD and investing in something that mature at the same time, like a government bill. You can say investment is done in T-bill. T-bill, you know, treasury bill you might have heard about it, right? So what will happen? So for 3 months, right, you have saved money in FD for 3 months and investing in something that mature at the same time, like a government T-bill. So suppose if interest rate rise after 3 months. So after 3 months the interest rate rise, right? But your FD and investment will renew. So interest rate rise after 3 months. Both your FD and investment will renew at higher rate. If they fall, if the interest rate fall, what will happen? If interest rate will fall, then both will renew at a lower rate. So here it is no surprise, no risk. So bank love this kind of perfect mismatch, right? So what is happening here? So this is the bank. It is taking FD. You are giving FD to the bank. So deposit it for 3 months. And where bank is investing? Bank is investing in treasury bill, which is a government bill. You know it very well, right? This is also investing for 3 months. Okay, and you can see that 91 day or 3 months, 8% deposit in 91 day treasury bill, earning 10%. Now what is happening here? That if interest rate increases, then also both will increase. FD will be will be at new rate, and treasury bill will at the new rate. And if interest rate decrease, both will decrease, right? So bank will renew at lower rate, both will renew at a lower rate. So here there is no surprise, right? So here there is a no surprise. Means bank love this kind of perfect match. Now the next question is, what happen if interest rate change, right? What happen if the interest rate change? Let's say interest rate goes up by 1%, right? Let us take an example to make it more clear. Suppose that interest rate goes up by 1%. So in the first scenario, we know this is the perfect balance, right? So let's say interest rate goes up by 1%. Now your FD, which was at 8%, now earn 9%. You see, your FD, that's the deposit, will be now earning 9%. Okay, and your investment earn bank. We are talking about from bank's perspective, and your investment earn 11%, right? So your profit margin remains the same. Obviously, profit margin is what? The difference between these two. So earlier it was 10 minus 8 and now it is 11 minus 9. It is still 2%, right? So no matter what happened to the interest rate, this is an ideal situation with no risk. Is it clear? So no asset liability mismatch is there, hence no interest rate risk is there. So suppose rate rise by 100 bps, the deposit renew at 9%, T will reinvest at 11%. So this NII 200 basis point NII preservation. So either we call it 2% or we call it 200 basis point. Both means the same, right? So this 200 basis point is still conserved, right? Now let's take a look at the scenario number 2. Now bank is taking FD for 3 months at 8%. I think you know the scenario. Now imagine a bank invest in a loan where interest rate change every month. That is floating rate loan. So bank has taken FD from you, and bank has invested in a loan which changes every month. That is called floating rate loan, whose interest rate change every month, right? But the deposit stay afloat, means deposit rate stay fixed for 91 days. Okay, what will happen? Now let's talk about it. Suppose interest rate increase. So you know, if interest rate rise, the loan interest increase twice within 91 days, because you know because the interest rate change every month. So this is the first month. After the first month, that is after 30 days, interest rate will rise, and after 60 days interest rate will rise also. So within this 90-month period, we can see two times the interest rate is rising for the loan, while the deposit cost will remain the same. So this means profit is higher for the bank, because what is the profit? Profit is the difference between the in how much interest it is earning and how much interest it is giving on deposit. So since interest rate is rising 2 times in this 90 days period or 3 month period, so ultimately bank is at profit, just like earning more rent while your EMI stay the same, right? Now suppose if interest rate decrease, now suppose interest rate decrease here, the loan rate drop, obviously the loan rate will drop, but the deposit cost remain the same, reducing the bank profit margin, and this is called NII compression. Here you can see NII compression, right? And the bank need to watch out for this. So this is the second scenario we talked about. This is called asset sensitivity. You know why it is called asset sensitivity? Because in this case we know that our deposit is fixed, but asset is sensitive to the interest rate change. That is why it is called asset sensitivity. Sensitivity means what? If interest rate is changing, asset value is changing, right? That is why it is called asset sensitivity. Now the third scenario we have is the liability sensitivity. This is the risky bit. Now this is where things get tricky. Let's see how. Imagine a bank give a 5-year fixed rate home loan at 10%. So this is the bank, it gives home loan at 10% interest rate for 5 year, right? But fund it using short term 91 day T-bill at 8%. Suppose the rate is 8%. So funding is done by short term T-bill at 8%, and it give home loan for 5 year at 10%. Now what could go wrong? So suppose two things happen. If interest rate increase, right, every 91 day bank has to renew deposit at higher rate. Obviously after first 91 day, after first 3 months, bank has to renew the T-bill, right? Suppose now it is 8%. Suppose it rises to 9%, sometimes 10%, sometimes 11%. So every 3 months bank has to renew this deposit at higher rate, right? But the home loan is fixed at 10% because this is the fixed rate, right? Clearly written, fixed rate mortgage, right? So sooner or later the bank is paying more for deposit than it earns on loan. It is earning at 10% only, but it has to pay more. Sooner or later bank has to pay more, right? So it is a big loss ahead. So this is the first case. Now suppose instead of interest rate increasing, interest rate decreases. Suppose instead of interest rate increasing, interest rate decreases. What will happen? Now deposit will renew at a lower rate. Instead of 8%, it will renew at 7% or 6%. So while the home loan still earns 10%, so this means higher profit. But bank can't rely on this luck forever, right? Bank can't rely on this luck forever. So what is the conclusion? That interest rate risk is like playing a balancing game. If bank get it wrong, they lose money, or worse, they could fall. Managing this mismatch is a key part of banking risk management, and for BFM examination this is a crucial concept to master it. I hope this is clear now. We have, so why it is called liability sensitive, because our loan was at fixed rate, whereas our deposit was changing, was varying, and since the interest rate was sensitive to the liability, or liability is sensitive to interest rate, that is why it is called liability sensitivity. I hope this is clear now. Now let's talk about something called basis risk. I think you know it very well, that basis risk is a type of interest rate risk. Let's talk about it in detail. Have you ever borrowed money and expected interest rate to move in a certain way, only to find out they did not? Imagine a seesaw where one side move up more than the other. So this imbalance is what we call basic risk in banking. So have you seen this seesaw? Obviously you might have seen this, something called seesaw. Suppose this side move larger than as compared to this side, other side. So this is what we call basic risk. So what is basic risk? Basic risk happen when the interest rate on a bank loan or deposit don't change by the same amount. So interest rate on loan or interest rate on deposit, they don't change by the same amount, even if their repricing happen at the same time. Sound confusing? Let's use a simple example, right? So what I told you, again I am telling the definition, that interest rate on loan, interest rate on deposit don't change by the same amount, even if their repricing happen at the same rate. So they are being repriced at the same rate, still the value is not changing differently. So friends, let me give you an example to clearly understand this basic risk. So here we can take the example of XYZ bank interest rate game, right? So here it is, XYZ bank interest rate game. So this XYZ bank has a mix of asset and liabilities. So when I say asset, it means the loan, and when I say liability, it means the deposits. So on paper everything look balanced. So you can see that on the asset side it has a call money of 50 crore, cash credit of 40 crore. So overall it adds to 90 crore, right? And on the liability side, which is repricing, means this can be priced again and again. So it has saving deposit of 50 crore and fixed deposit of also 50 crore, right? Because you know that when interest rate will change, then this also will change. So overall it adds up to 100 crore. So both asset and liability are repriced at the same time, so no mismatch, right? Wrong. That is wrong. Here is the catch. Just because repricing happened together does not mean that interest rate moves equally, right? If I say that repricing happened together, it does not mean that interest rate will also move equally. Let me give you some example to make it more clear, right? So for example, let's say the first case, unequal changes, unequal increase. So let's take an example. So suppose I take about unequal increase. You know, the loan rate rise by 1.5%. The loan rate rise by 1.5% while the deposit rate rise by 2%. So this is an unequal change. So you know, in this case what will happen? The profit will shrink because deposit cost increases more than the loan earning, right? In this case what will happen, the so here you can see, I will tell you, give you quantify it also. So let's take the first case. Suppose there is an unequal increase, that loan increases by 1.5%, deposit increases by 2.5%. so what will happen? The profit will shrink. Simply I will say that profit shrink, right? Now let's take a second example. Suppose we have unequal decrease. So one case is of unequal increase, second case of unequal decrease. What about unequal decrease? Suppose loan rate drop by 1%, loan rate drop by 1% and deposit rate drop by 0.5%. Okay, now tell me whether profit will increase or profit will decrease or loss will happen. Tell me. Loan rate decrease by 1% and deposit rate decrease by 0.5%. So in this case you can see that profit will increase, right? Because deposit cost fall more than the loan earning, right? So this is called unequal decrease. So basic risk might sound small, but over time it directly impact a bank profitability. Even if everything look balanced on paper, these small difference in interest rate movement can cause unexpected gain or loss. So what we learned is that matching repricing date is not enough. Right? Repricing date matching is not enough. Rather, bank must ensure that movement in interest rate on loan and deposit is predictable and manageable. Otherwise, basic risk can slowly eat into profit without warning. I hope this makes sense to you. Now, let us talk about what is the impact on basic risk on NII. We will talk in detail how does it affect net interest income. So here we have a scenario before you. I will explain in detail. So imagine you are running a business where both your income and expense depend on interest rate. Now, what if the money you earn decreases faster than the money you spend? That is exactly how basic risk impact the NII. Let's break it down in simple terms. Right now, our bank has a negative gap of 10 crore. So you can see it easily that liability is 100 crore and repricing asset is 90 crore. So you know, when I say gap, it means that how much we are earning minus how much we have to give. So bank earning from loan is 90 crore and bank has to give 100 crore in the form deposit. So obviously the gap is minus 10 crore. Obviously the gap is negative, right? So gap is negative of 10 crore. So this is the situation here now, which means it has more interest bearing liability than interest earning asset, or we can say it has more rate sensitive liability RSL as compared to RSA, rate sensitive asset. Is it clear? So we can call it RSL and RSA. This term will be frequently used. So when I say RSL, it means rate sensitive liability and RSA means rate sensitive asset. Now the question is, what will happen when interest rate drop by 1%? So I say interest rate drop by 1%, what will happen? Let's try to understand. Normally we expect this to improve NII by 1 crore, right? Assuming all rate fall equally. We assume that interest rate on loan also fall by 1%, interest rate on deposit also fall by 1%. So we assume that our NII will improve by 1 crore, right? But in reality, different rate don't move the same way. Let's see what is actually happen. So let's see the realistic picture here. So we can see the lending rate. So first of all, let's talk about the lending rate, right? So realistic rate change you can see. So first of all, let's talk about the lending rate. So when I say lending rate, it means we are earning money. So by lending only bank earn money. So lending rate, you know, this call money drop by 1%. Call money drop by 1%. Okay. Now call me, what was the call money amount? The call money amount you can see is 50 crore, right? So here you can see call money amount is 50 crore. So drop by 1%. So can you tell me what will be the final amount? So 51% of 50 crore will be how much? Obviously 1% is 0.5 crore. So bank will earn 0.5 crore less, isn't it? Now cash credit, CC, you know, CC drop by 0.7%. That is what I am telling you now, that if interest rate decrease by 1%, different assets decrease by different percent. So cash credit drop by 0.7%. What was the initial value of cash credit? Let's see. The initial value is 40 crore. And what is 0.7% of 40 crore? So 7%, you know, 2.8 crore. So 0.7% is 0.28 crore. So bank will earn 0.28 crore less, isn't it? So can you tell me what is the total loss in income? Total income loss. Total income loss is how much? 0.5 plus 0.28, which is 0.78 crore. So this is the total income loss. Now let's talk about the deposit rate here. In this side, let's talk about deposit rate. And when I say deposit rate, it means bank is paying money. Bank is paying money. Now we have deposit from saving account. Let's say saving account rate dropped by 5.5%, right? So what is the saving amount currently? It is both are 50 crore. So what is 0.5% of 50 crore? This is nothing but 0.25. This is nothing but 0.25 crore. So it means that bank saved this 0.25 crore. It is saving, right? Why it is saving? Because deposit rate decrease, so bank save 0.25 crore. And if we talk about fixed deposit, so FD, suppose FD rate decreased by 0.4%. So in this case also, if you calculate 0.4% of 50 crore, you will get 0.20 crore. So this is also saved by the bank, right? So if you add both of them, total saving is how much? Total saving is how much? 0.25 plus 0.20, which is 0.45 crore, right? So let's do the math. So you can see that loss in interest income is 0.78 crore, right? So what we have seen, that loss in interest income, let me erase it. So here it is 0.78 crore and here it is 0.45 crore. So I can write it that loss in interest income is equal to 0.78 crore and saving in interest expense is 0.45 crore, right? So ultimately overall the bank faced the loss. So what is the overall loss? What is the overall loss? It is equal to 0.78 minus 0.45 is equal to 0.33 crore. So this is the overall loss. Is it clear? So even though rate fell, instead of making a profit, the bank actually lost money. Why? Because the interest on loan fell more than the interest on deposit, right? Interest on loan fell more than interest on deposit. That is what calculation has been done here. Same calculation has been done here. So ultimately, if interest rate is decreasing, we were assuming that interest rate on loan as well as the interest rate on deposit will decrease by the same rate, but it does not happen. Interest rate on loan decreases farther more than the interest rate on deposit, and this causes our ultimate loss, right? So the key takeaway is that just because interest rate move does not mean that they move equally. Bank must manage basic risk carefully to protect their earning. A negative gap does not always lead to higher NII when rate fall. It depends on how each rate moves. Is it clear? So I hope this concept is clear to you, that how to go about deciding the ultimate NII change, right, whenever interest rate move. Now let's talk about more about this basic risk, right? So everyone wondered why bank don't always profit when interest rate change, right? So even if they are perfectly timed their investment, there is a hidden danger which we call as basic risk. And wait, there is more. Bank also face risk when customer repay loan early or withdraw deposit before maturity. So we will talk about it later. So imagine you have two investment, right? Suppose you have two investment. On one you are earning interest like loan given to a customer, on one or you have to pay interest like for bank deposit. Now let's say interest rate change, you expect both to move equally, right? But suppose if loan rate drop by, this is a loan rate drop by 1% and your deposit rate drop by only 0.5%, right? So the bank earn less but still pay almost the same amount on deposit, right? But still pay almost the same amount of deposit. That's the basic risk. Even if repricing date are perfectly matched, bank can still lose money because interest rate on asset and liability do not change by the same amount. Now the question is, why should bank care about the basic risk? Because in a volatile risk environment, right, you can see in the volatile interest rate environment, bank can see unpredictable profit and loss. Basic risk can eat into earning even when bank think it has hedged risk. Now the next risk we have is called net interest position. So we have known what is basic risk. Now let's move to the next kind of interest rate risk, that is called NIP, net interest position risk and embedded option risk. Think of a bank as a shop. So you can imitate this bank as a shop. Shop. So if it lend more than it borrow, it makes money when interest rate increase. So suppose it lend more than it borrow, so what will happen in that case? If interest rate increase, ultimately bank will make money, or we can say it will be at profit. And suppose, and when rate fall here, if rate decreases, so it earn less because it loans now bring in less money, right? So that is what I am saying. Suppose the bank is lending more than it which is borrowing, and interest rate increases, right? So it make money in that case. And if interest rate decreases, then it earn less, right? It earn less. That is the point. So there is something called positive net interest position, right? So there is something called positive net interest position. When I say positive net interest position, it means we are lending more than we are borrowing, so it will be profitable when rate rise. And it will be, and there is something called negative net interest position, right? When I say negative interest rate position, it means more deposit than loan, right? So if I say about negative interest rate position, it means our deposit is higher than the loan, right? So in this case, it will be profit when rate fall, it will be profitable when rate will decrease, right? It will be profitable when rate will decrease. So a bank must carefully balance its interest earning asset and interest paying liability to avoid the losses. I hope this is clear now. Now there is something called embedded option risk. Now let's talk about another hidden risk, which is the customer choice. That early loan repayment. So there is a chance of early loan repayment, prepayment of loan, that is what we call, or bonds. So if interest rate drop, borrower rush to prepay their loan and take new loan at lower rate, right? Suppose the interest rate drop, what the borrower rush to prepay their loan and take new loan at lower rate. So the bank loses out because it is expected to earn interest for a longer period. And now sometime what happened, that there is called early withdrawal of deposit. So sometimes that there is a early deposit withdrawal also. Why it happened? Because that if interest rate rise, depositor withdraw money early to invest in higher paying option. The bank now has to offer higher rate to attract new deposit. So early deposit withdrawal when interest rate rise, because the people head to the bank to early withdrawal of deposit, and they want to invest again. So because the bank is offering higher interest rate, so bigger the interest rate swing, the greater the risk. So what we have learned till now, we have learned the three important kind of risk. The first risk we have dealt with the basic risk. The basic risk is what? Interest rate don't move equally. That means bank earning fluctuate. Then we talk about net interest position. So it means bank profit depends on the rate direction, right? Whether the rate is, whether we are lending more or whether we are borrowing more, right? And in which direction interest rate is moving. So rate direction, when I say rate direction plays a super important role, it will call NIP. When I say interest rate do not move equally, no equality, then it called basic risk. And the third risk we are talking about is the embedded option risk. This is also kind of interest rate risk. Means customer change plan when rate change. Whenever rate will change, customer change plan. So suppose customer has taken the loan and interest rate decrease, so they will prepay their loan and they will again bout loan at a lower interest rate. Similarly, when there is an increase in suppose customer, when there is increase in interest rate, what customer will do? Customer will withdraw their deposit and again reinvest it at a higher interest rate. So that is why whenever rate will change, the bank is exposed to embedded option risk. I hope it is clear. Now let me give you one example of this embedded option risk. So imagine you rent out your house for 3 months at a fixed rent, right? So let me give you an example to make it more clear. So suppose you rent your house for at a fixed rate of for 3 months, right? But just after 1 month, the tenant decide to leave early. Now you have to find a new tenant, but the market rent has dropped. You expected a steady income, but your earning just took a hit. This is exactly what happened to bank when borrower repay loan early due to falling interest rate, and that is called embedded option risk. Let's understand this with an example. So let's say a bank give a 90. So suppose this is the bank, it give 90 days loan to a borrower at 10% interest rate. Okay, now to fund this loan, bank collect deposit for 90 days. The bank collect deposit from 90 days at 8% interest rate. Initially, what is the profit for the bank? It is 10 minus 8, which is 2%. This is NII. Initially, this is NII, net interest income. Now, so 10% is the loan income, 8% is the deposit expense. The final will be 2%. But here is where the problem start. The borrowers see a new lower interest rate of 9% in the market and decide to prepay the loan. What does the borrower see? Borrower see that the new loan interest rate is just 9%. So what he did? He prepaid the loan. The borrower prepaid the loan, right? So now the bank get its money back early and must reinvest it at lower 9% rate. Obviously, a bank which was supposed to get at 10%, now it get back the payment early, and now it has to reinvest at 9% rate. So what is the impact on bank earning? For the first 30 day, bank earned 2% as expected, but for the next 60 day, right, after 30 days, suppose that person go to the bank and give the entire amount as a loan, which is taken as a loan. That means he prepaid the loan. Now after 30 days, now for the next 60 day, what happened? That bank has to reinvest that 9% instead of 10%. Right, so ultimately the profit is reduced by 1%, because now the interest that is called in rate sensitive asset is invested at 9%, or rate sensitive asset is 9%, or and deposit is still 8%, so the difference is only 1%, right? So for the next 60 day, bank reinvest at 9% instead of 10%, reducing its profit to just 1%. So instead of earning 2% profit for 90 days, the bank just losses out for the last 60 days because the borrower prepaid the loan, right? So embedded option risk is a big deal, especially in India's volatile interest rate market. You know it very well. I hope this is clear now. So what we learned, that when interest rate drop, what borrower will do? So borrower will prepay the loan. Right? So bank earn less. Now second thing, when interest rate will rise, what will happen? Depositor will withdraw early. So here also bank pay more. So the faster and bigger the interest rate change, the more bank struggle to maintain profit. So what we have learned, that embedded option risk happen when borrower and depositor changing plan when interest rate change. Bank lose earning when loans are prepaid early due to falling rate, and volatile interest rate make risk management crucial for the bank. Now let's talk about the next kind of risk we have. It is called the reinvestment. Talk about the yield curve risk. So have you ever noticed how interest rate on short term loan are different from long term loan? So if you take short term loan, suppose I take two type of loan. One is the long term loan and other is a short term loan. So you can see that interest rate on the long term loans are different from the short term loan, right? Sometimes they move up and down unpredictably, affecting bank's profit. Right, now imagine a bank earning good money today but suddenly losing it in the next quarter because of the something called yield curve risk. What is it? Why does it happen? And how does it impact a bank? Let's break it down in a super simple way. Now first thing is that what is yield curve? So the first question is, what is yield curve? Think of the yield curve as a graph that show interest rate for different loan duration. So you can think of this yield curve just like a graph, right? You can think of like a graph that represent interest rate for different loan duration. So you have different loan duration. It might be short term, it might be medium term, it might be long term. So these are the different terms of the loan, right? Different loan, and this yield curve represent the interest rate. So interest IR1, IR2, IR3. So these are the different interest rate for these kinds of loan. Normally, longer term loan have higher interest rate than the shorter term. So this IR3 will be greater than IR1, right? Remember, longer term loan has higher interest rate than short term one. But sometimes due to economic condition, this curve changes shape, right? So if short term normally it happens that in long term, if you have long term loan, interest rate will be higher as compared to the short term loan. But what happened, because of sometimes due to economic condition, you can see sometimes due to severe factor, right, due to economic condition, this yield curve fluctuate due to some economic condition. So how it fluctuates, let's see. Suppose the short term rate rises above long term rate. So suppose IR1 is greater than IR3. We call it inverted yield curve. This is called inverted. Normally what happens, IR3 is greater than R1, but sometimes if IR1 is greater than IR3, so this is called inverted yield curve. You should know it. And the second thing is that if long term rate rises too much, bank may struggle to lend affordably. So let's take an example to make this concept more clear. Now you understand what is yield curve. These are the graph that shows interest rate at various kinds of duration, for long term, short term, medium term. So let's take an example here. So let's take XYZ bank. It gives 3 years. So let me show you what is happening here. So this is our XYZ bank, right? This is our XYZ bank. It gives a 3-year floating rate loan, right? And fund them using a 3-year floating rate deposit. Okay, 3-year fixed deposit, not floating. This is fixed, but this is floating. Is it clear? Okay. Now both adjusting every quarter. Fine. Let's see how bank make money. So it pay 13% interest on deposit. So what is the interest rate? 13%, or let's say 13.5 to be more precise. So let me use different color here. Just wait a minute, I am using this. So 13.5% interest on deposit, and it has to pay, it charges 16% on the loan, right? So what is the profit margin for the bank? So margin is how much? You can see it is equal to 16% minus 13.5%, which will be 2.5%, or we can call it 250 basis point. Is it clear? But what if yield curve invert next quarter? So this is the first quarter. Now suppose I am asking you one question. What if this interest rate invert? So when I say interest rate invert next quarter, or yield curve, not interest rate, this yield curve invert next quarter. So what will happen? So it simply means that short term interest rate, suppose it is 91-day treasury bill, right, jumps from 12.5% to 14%, right? If yield curve invert next quarter with 91-day treasury bill rising to 14%, right? So I think it is 12.5, right? Bank pays 100% deposit and above the, okay, fine. So this 13.5% that the bank pay, which is 100 basis point above the 12.5% 91-day treasury bill rate, right? Okay, this is the treasury bill rate. So we are comparing with the treasury bill rate, right, which is a medium term loan. We are comparing with that. Now so if the yield curve invert next quarter, what will happen? That this short term interest rate, which is 91-day treasury bill, earlier it was 12.5%, now it jumped to 14%, okay, and the long term rate, which is 364-day treasury bill, still stay at the 13%. Now the bank profit margin shrink to just 1%. Now right now it is 2.5%, but what will happen after? It will just shrink to 2%. They just shrink to 1%. So you can see how it is done. So our lending rate is 16%. Is it okay? And this is our 14 interest rate. What will happen? It rise to the 14%, right, plus 1%. So this will give you how much? Minus 2% plus 1%. So in NII drop by 100 basis point. So when the yield curve shift unexpectedly, banks struggle to maintain their interest income, right? That is what happened. If the yield curve shift unexpectedly, banks struggle to maintain their interest income. If short term rate rise too much, borrowing cost increases. If long term rate drop, bank earn less on loan. If the bank mismanage their risk, their profits shrink and financial stability will weaken, right? So this is how this yield curve risk plays an important role. So what we learned, that yield curve represent interest rate across different maturity. Change in the curve impact bank NII. An inverted yield curve can reduce bank profit drastically, and RBI policy and economic condition plays a big role in shaping the yield curve. Then we have the next kind of risk, which we call as the price risk. So we have talked about basic risk, we have talked about net interest position risk, we have talked about embedded option risk, then we have talked about the yield curve risk. Now the next type we have is the price risk. So let's understand what is this price risk all about. So friends, you know that imagine you buy a gold chain today for rupees 50,000. So let me take you example. You buy a gold chain today for say rupees 50,000. A few months later, gold price drop, and now your chain is worth only 45,000. So a few months later, your chain is worth only 45,000 rupees. If you sell it now, you will lose money. The same thing happened with bonds and financial asset in the bank. So here I am talking about bond or some financial market asset in the bank, right? This is called price risk, and today we will decode it in the simplest way possible. So the first question is, what is this price risk all about? What is this price risk? Let's understand it. So price risk happen when the bank sell an asset before maturity and its price has changed due to market condition. So whenever banks sell an asset before maturity, right? Whenever banks sell an asset before maturity and its price has changed due to market condition, this is what we call price risk. And there is a key rule in finance. In finance, there is a rule which you must remember. The rule is that when interest rate goes up, bond price goes down, and when interest rate decreases, bond price goes up. You know it very well, right? So price risk when it happen, when banks sell an asset before maturity and its price has changed due to market condition, then price risk happens. So here is the key point: assets are sold before maturity, right? Let me give you an example. Imagine a 10-year government of India bond, that pays 14% interest per year. Now suppose if the interest rate in the market stays the same, the bond price will remain the stable. But suppose if interest rate rises to 15%, right, what will happen? New bond will have higher return, right? So your 14% bond loses value because investor prefer the new higher paying bond, because interest rate has risen. So investor will prefer this 15% bond, not this 14% bond. So what will be the result? If the bank sell this bond before maturity, it incur a loss. So what is happening, that first of all, what happened, that bank has 10-year government of India bond that pay 14% interest per year, right? And interest rate in the market stays stable, nothing will happen, bond price remains the same. But suppose interest rate will rise to 15%, so new bond will give higher return. So your old 14% bond loses value because investor always prefer the new bond. So what is the result? The result is that if the bank sell this bond before maturity, it incur a loss. So many banks trade in government bond and financial security, you know it very well. But when interest rate fluctuate unexpectedly, many bank invest in it, right? Many bank invest in government bond and financial market. But if interest rate fluctuate unexpectedly, they can lose money instead of gaining it. If the bank sell asset at the wrong time, they book loss. If the bank hold asset for too long, they risk missing out on better return. And if interest rate are not managed properly, bank profitability suffer. So this is why managing price risk is crucial part of banking. So what we learned in this particular slide, that price risk happen when assets are sold before maturity at a lower price. Bond price and interest rate move in an opposite direction. If interest rate is higher, lower bond price, and there is a risk of loss because your investor or your depositor will prefer higher rate bond. So bank must carefully time their trade to avoid big losses. So I hope the price risk is clear. Now we will cover the reinvestment risk in the upcoming lecture, in the part 2 lecture. So that's all for first lecture. I hope this make your concept clear. Do hit the like button, do subscribe to our channel to get more insight. Thank you.